Here we are, Taxes 101. Everything you need to know about taxes, we're going to learn today. As you may know, I've been in the tax industry for more than 25 years, and I have trained a lot of people, accountants, attorneys, CPAs, and I teach for the Small Business Division of the IRS. And I wanted to put together this class. Finally, it came true. We're doing it. What do you think? Should we start? Welcome to Global Tax, Taxes 101. Everything you need to know about taxes, you're going to learn today. Our approach to these classes, we're going to teach in sections. And remember, after each section, you can ask questions. Do not hesitate to ask. It shows that you're interested in the subject, and we are very happy to answer your questions. We're going to have our tax definitions and summary, and we're going to talk about the tax reform, the Tax Cuts Jobs Act, which is a tongue twister for me somehow, which is the biggest piece of legislation in the history of taxes. And we're going to also talk about the new tax tables because that's part of the tax reform. The content that we're going to cover is quite extensive, so we're going to divide it in different sections because it's a lot of information to absorb. Remember, again, to ask questions when you have doubts. We're going to talk about why taxes exist. We're going to talk about importance, the tax tables, what's taxable income, non-taxable income, the Tax Cuts Jobs Act, and all of those pieces of information that are essential for you to know about taxes. And that's why it's called Taxes 101, because we're doing the very basic, the very beginning tax education. So you can become a tax expert in the future. The first thing people want to know is, what are taxes? It's such a foreign concept. You know, I've been in this country for 30 years, and I've been practicing tax law in the tax world for more than 25. But as an immigrant, for me, I had the education, fortunately for me, about taxes, but I know that a lot of people are intimidated about taxes because we come to a foreign country, and even, local US people are intimidated about taxes because taxes are complex and are intimidating, even for the most educated stratus of the population. But what are taxes? Well, taxes are involuntary fees that are levied on individuals or corporations, and they're levied on individuals, human beings, and corporations that are entities. But for tax purposes, corporations are treated as people. So it's like if corporations are people, and they are involuntary because nobody really want to pay taxes, right? And they are levied in the sense that they are enforced by a government authority, whether federal or local for states. And the idea of the taxes is to finance government activities, among other things. Taxes, whoever has to pay the burden of the taxes, it could be an entity like a business, or it could be a consumer. At the end, the taxes will fall in whoever is responsible to pay it. Taxes are everywhere. Everywhere you turn today, everybody's complaining about how much money they have to pay in taxes. But what are those taxes for? They've been around the United States since the United States before it became a country. And the Constitution granted, when the Constitution was written, it granted the federal government and each state the authority to impose taxes, with the idea of financing government activity. That's how they impose tax. And we all know that even religion reasons apart, even the Bible quote that Jesus Christ said, pay to Caesar what Caesar's and to God what's God. So taxes have been around forever, since the history of humanity. So now, why taxes exist? The reason why government imposed taxes on individuals and corporations is as a means of raising revenue, of raising income, because the government per se does not have a source of income. We have natural resources, so there's a way the government can generate income, but a more secure way, because not all countries are blessed with a lot of natural resources, like let's say petroleum, let's say diamond, gold, then you can generate income from those. But if you don't have natural resources that you can rely on, then taxes are a sure way of raising revenue, so the government can comply with and can meet all the needs for the general welfare, for the budget, etc. So with the taxes, you can finance government projects, public projects, and you also make the business environment in the country conducive for economic growth. So there is the principle of taxes being not only a means of revenue, it's that what you do with that revenue, which is to help with the economy and financing the government and the public projects, among other things. Importance of taxes. Why are taxes so important? I think we already talked about it, because when we spoke about why taxes exist, we kind of say, why are they important? Like I said before, they help fund the public schools, the police department, the construction of roads, the hospitals. All of these benefits that we have living in this country are financed through the collection of taxes. So without the taxes, the government would not be able to meet the demands of their citizens. They are crucial, because through the payment of taxes is how the government collects the money and use that money for financing social projects. It is something that of utmost importance to understand, because a lot of other countries that we know United States is the kind of the promised land. Everybody wants to be here and come here. And it's because the taxes are, the money that people pay in taxes are, you can see that they're redirected for the general welfare. So you can see how the streets and the roads and the public schools and the hospitals and and the police department, everything that is a necessity for the public and society at large, you can finance through the payment or the collection of taxes. So part of the social projects that we talk about that are financed by the payment or the collection of taxes include health, education, governance, the government itself, infrastructure development, transportation, scientific research, security, environmental protection, unemployment benefits, childcare, pensions, housing, etc. So now that we know the taxes are important, what are taxes, why are they important, what they finance, we want to know what are the different types of taxes. And United States has a very complex tax code. However, the type of taxes can break down into simple categories. Let's see which ones are these. The first category will be indirect taxes. As the name suggests, an indirect tax is collected by one entity on behalf of the government and is not directly collected from the taxpayer. Okay, so it's passed to the consumer as part of the purchase price of a good or a service. It is the body that collects the tax from the consumers will afterwards remit it to the government, and ultimately the consumer is paying the tax by paying more for the product. A good example of that is the VA tax, the value added tax, or sales tax, like we call in the United States. The toll road is an example of an indirect tax. Sales taxes that we all know that we pay for the sales price, but we add the sales taxes. So the person that is selling that product to me will collect the taxes on my behalf and remit that payment to the government. So it's been an indirect taxation, but ultimately me as the consumer are the one paying the taxes. Excise taxes, which are tax, for example, for liquor, tobacco, firearms, they are all examples of indirect taxes. So the next category is direct taxes. A direct tax, as the name say, is the tax that is paid directly by the individual or the organization to the imposing entity. So you cannot pass it to a different individual or a different organization. You're responsible if you have to pay to the federal government, your federal income tax, for example, you pay directly to the imposing entity. And if it's a state tax, you pay directly to the state, for the sake of the example. A good example is that when you say that you pay taxes directly to the government for different purposes, including real property tax, which is the tax that you pay when you own real estate, personal property taxes, which is the taxes imposed for vehicles, boats, luxury tax, taxes on assets, or the income tax, which is the most common one, in which we pay federal taxes or state taxes depending on our income and depending on the state, because some states are tax exempt. Not tax exempt. People do not pay state taxes. So those are the most common type of direct taxes. So we know we have taxes, direct, indirect taxes. So we also know that we are surrounded by taxes. Everywhere we look, there are taxes associated. We go to the airport, or on the way we have to pay the toll. That's the toll road, so we receive a service in exchange for paying the toll. We have the sales taxes, which is an indirect tax that we pay as consumers. So for everything we buy and consume, we are going to pay sales taxes, which is an indirect tax. Excise tax, which is another indirect tax on the sale of particular goods like fuel, tobacco, alcohol, firearms. And those taxes are already added to the price, so we don't really see. It's not like the sales tax that you see in when you get your ticket, you see, okay, sales price this much and sales tax this much. When you buy the fuel, the tobacco, and the alcohol, is already added to the price. And the producer, the alcohol manufacturer or the tobacco manufacturer will pay the taxes directly, the excise tax directly to the government. Corporate tax is a direct tax that is tax on profits of corporations. And this only applies to C corporations, because there are other corporations that are considered pass-through entities and they're not taxed at the corporate level. Of course, these taxes, like all taxes, are taken by the government to fund federal programs. So now we know a lot about taxes, right? We know that the taxes are important. We know that there are two classes. There are indirect and direct taxes. We know that taxes are imposed, that they're not voluntary. Otherwise, nobody would pay taxes. We know that they are collected and they are used to finance social projects, to finance the government for the public benefit. And in the subject topic that we want to talk today, we want to talk about income taxes, because income taxes are the more impactful for all the population, and is the one that we all want to know about. Income taxes are calculated as a percentage and is assessed progressively, meaning the higher the income, the higher the percentage of taxes that will be imposed. This is the tax that is paid, again, percentually and progressively with respect to the income of individuals and legal entities, the ones that are taxable, such as the corporations, because as I told you before, there are entities that are passed through and they don't pay taxes at the corporate level. By law, income taxes are filed annually. So every year you earn the income and you have to pay the taxes. However, the taxes are never filed in the year the income is earned or generated. For the sake of the example, this class is being recorded in 2019, but in 2019 we're going to file taxes for 2018. One of the most important principles of taxes is the just redistribution of wealth. United States, like most countries, employ a progressive income tax system in which higher income earners pay a higher tax rate compared to their lower income counterparts. This is called the just redistribution of wealth, and it technically, supposedly, it will achieve that supposedly people that earn more will pay more in proportionality to their income. But sometimes it does not happen like that. People who are wealthy do not necessarily pay taxes the same way they should or proportionate to their wealth. We see many examples of really wealthy people that end up paying no taxes, which is why pretty much alternative minimum taxes were created by Congress, because there were a lot of wealthy individuals that has tax attorneys like me and will have a lot of tax breaks or tax deductions legally. You know, this is not tax evasion, this is tax avoidance, and this is people that were using all the tax instruments or all the benefits of the tax code, and they end up paying no taxes even though they were really wealthy. So we want to understand that this is what in principle the taxes are, that you should have a just redistribution of wealth, but that's not always the case. When we talk about how the taxes are progressively, right, we talk about the just redistribution of wealth, and we say that in theory, the higher the income, the higher the tax the person or entity should pay. That is because taxes are progressively, and we have what is called a tax rate. And the tax rate is, by principle, the proportionality and progressivity of the income tax is done by using a tax rate. So let's define what a tax rate is. A tax rate is the percentage numeral used to multiply by the individual's or entity taxable income to calculate their tax liability. Therefore, the percentage of taxes should increase as taxable income increase, because we say it's proportional and it's progressive. So we know that the tax rate is that percentage numeral, that 10%, 12%, whatever number that I'm gonna use to calculate what my, to multiply my taxable income so I can know what my tax liability is. But so what's taxable income? Taxable income is that amount of income that is used to calculate how much tax I have to pay, a person or a company has to pay in any given year. One important distinction is to know that taxes are never calculated on gross income. Section 61 of the IRS Code defines gross income, and the definition includes several categories of income, and one important distinction, what the code says, is gross income from whatever source derived. What does that mean? It means that even if it's illegal income, it means that they don't care of the source. If you have income from an illegal activity, you still have to pay taxes on it. Like the better example would be Al Capone. They couldn't prove anything, they couldn't put him in jail until they got him for tax evasion, because he was supposed to claim to file taxes on the income he was getting for contraband, which is an illegal activity, but because the code definition is very broad and it says for whatever source derived, we need to pay taxes for whatever source. No matter the source of the income, you still have to pay taxes, but it's not calculated on gross income. It's calculated on taxable income. So there are two types of taxable income: earned income and unearned income. Earned income includes salary, wages, bonuses, commissions, and a good way to understand the difference between earned income and unearned income is when the labor, the sweat and labor is involved. Like I always joke and I say, it's the money that you earn by the sweat of your forehead and other parts of your body. It's a joke. It's a joke. So whenever you are putting effort and working, and then we use the expression about sweating, then you will consider that earned income. So by now we know a lot. We know that there are different types of taxes, direct and indirect. We know that there is a tax rate that is applied against taxable income. We know Section 61 that talks about gross income from whatever source derived. So that made me think that all income was taxable. And now I am telling you that there is something called non-taxable income. And non-taxable income are items of income that are specifically excluded by law, meaning that the IRS, Internal Revenue Code, have sections that specifically will exclude these items of income with these categories of income from being taxed. And there are several examples of that. We have certain death benefits. We have gifts and inheritances, which is Section 102. And gifts and inheritances is a very interesting topic because people are all confused. We're going to have a section after this because this is Taxes 101. So we're giving you the very, very, very basic. But then after, we're going to have more webinars in which you're going to be able to learn the intricacies of all of these non-taxable income and other taxable income sources. We have interest on state and local bonds, which is Section 103, I think. We have compensation for injuries or sickness, which is Section 104. And the idea of this behind non-taxable income in cases like Section 104 is because there's no way somebody can compensate you when you have an injury or a sickness, or the disability or a sickness. And then because no money technically can compensate you for that, they make it non-taxable. They make the recipient of these items of income non-taxable, meaning they don't have to pay taxes on it. There are qualified scholarships, which is Section 117. There's exclusion of gain from sale of principal residence, which is Section 121. And it means that we're going to have a class about that, but it means that when you sell your principal residence and you have lived in it for more than 2 years as your principal residence, you can exclude up to $250,000 of that gain, meaning that is tax-free. Anything above that, you will pay taxes. COBRA premium assistance, which is when people have lose their job and then have the COBRA pay assistance for the health insurance. Workers' compensation, the same concept. People got injured while working and get workers' compensation, so it should not be taxed on that. Alimony starting in 2019. Alimony was taxable. With the Tax Cuts Jobs Act, it has been excluded, meaning it's non-taxable for the recipient and it's not deductible for the payer. So that really is something that a lot of people are not happy about. And welfare income and child support payments. Foster payments, people that take kids as foster kids and the government pays them to take those kids, that's also non-taxable. So these are pretty much all of the items of non-taxable income. You remember when we talk about the different, when we talk about the tax rates, and we say that it's a percent, it's a numeral that we applied against taxable income to calculate a person's or entity tax liability. To get to that amount of taxable income, like I said before, you're never taxed on gross income. You need to reach to an amount which is called the taxable income, which is what we need to calculate in order to use that tax rate or that tax table and do the multiplication and know what is our liability. Before that, we need to know a very, very important concept, which is called adjusted gross income. In the tax argot, we just call it AGI. So we just say AGI and you will know it's adjusted gross income. Adjusted gross income calculations are very important because many thresholds and limitations and credits and phase outs are depending on the AGI amount. How do we calculate AGI? AGI is calculated by subtracting certain items that are allowed by the law, and they're called adjustments. Just like non-taxable incomes are items of income that are excluded, adjustments to income are just certain items that the law specifically called adjustment to income. And an adjustment to income will reduce the gross income dollar per dollar to reach the AGI. So the formula to calculate AGI will be gross income minus the adjustments is AGI. So what we're trying to do here is to reach the concept of taxable income. But before we can go there, we had to go by steps. And I'm using the steps that I feel the legislator used when creating the forms. Specifically, we're talking about income tax for individuals. So the form 1040. When the legislator created the form, it went through steps. We have gross income, and then we have adjustment, to the gross income, which will give me the adjusted gross income. After I have my AGI, then I want to apply deductions. So what is a deduction? Because there's a difference between a deduction, an adjustment, a credit. So what is a deduction? A deduction is an amount allowed by law that help me reduce my adjusted gross income. It's just a category of an expense that the law specifically say you can use this deduction, okay? And that will reduce your adjusted gross income. So you can arrive to the taxable income, because as I said at the beginning, we're never taxed on gross revenues. We're never taxed on gross income. We need to have certain deductions and adjustments taken before we can arrive to the taxable income and use the tax table. There are two types of deduction currently: standard deduction and itemized deductions. Taxpayers get a bigger deduction by using the itemized deduction versus the standard. Itemized deduction require that you record all allowed expenses incurred during the tax year. So there are specific items. They're taken on a schedule called Schedule A, and they're specific. The law will tell you which deductions are those. And when you subtract that from your adjusted gross income, then we are closer to getting our taxable income concept that we need so much so we can calculate our tax liability. So as I told you, we have two types of deductions that are allowed by law. The standard deduction, which is a number that the government pick. And the standard deduction is pretty much a fixed dollar amount set by the IRS every tax year, and it will vary depending on your filing status. The filing status are 5: single, married filing joint, married filing separate, head of household, and qualifying widow or widower. Depending on those filing status, this standard deduction will be higher, right? It makes sense. I mean, if I'm going to give standard deduction to a single person, it cannot be higher than the standard deduction to a couple filing joint, because technically, like we spoke at the beginning about the just redistribution of wealth, a single person will have less expenses or less cost of living than a married couple. Because the standard deduction pretty much is trying to do, which I find it funny because standard deduction is technically based on the cost of living. So the government presumes that a single person can live with $12,000 a year. I mean, that's it. That's enough, apparently. But anyways, that's a fixed amount that is set every year, and with the Tax Cuts Jobs Act, the standard deduction got bumped, got double almost. So we're going to see that later on. This is the easiest deduction to take because there are no calculations to make, no receipts to gather, no additional funds to prepare. You just take the standard deduction, you look at the table, you look at your filing status, and you look at the standard deduction, and then that's what you use. So that's the easy one. But keep in mind that while being easy, it will not always give you the best result. It will not be the best choice because you want to reduce your tax burden to the lowest level. So sometimes, if you can, it's better to itemize. And when you're doing a tax return, you take whichever is greater. Either you take the standard deduction or the itemized deduction, whichever is greater. So the Tax Cuts and Jobs Act increased, as I told you, the standard deduction amount from 2018 to 2025 because that's the scope of the legislation in 2025. If Congress will extend it. We don't know what's going to happen, so we're going to say just for what it is now, from 2018, which is the tax year that's going to be filed in 2019, up to 2025, the standard deduction is as follows. It's $24,000 for married filing joint or qualifying widow. It was to $12,700, so it almost doubles. $18,000 for $9,350 for head of household. $12,000 from $6,350 for married filing separate or single filers. So that's a big bump. A lot of people that itemize, they're not going to need to itemize anymore, because with the $24,000 standard deduction for a married couple or a qualifying widow, if the mortgage and the taxes do not amount to $24,000, you're better off taking the standard deduction. And people that are blind or 65 years or over get an additional deduction of $1,600 or $2,600. There's certain items that the law specifically says that I can deduct, certain expenses that I can deduct. Unlike the standard deduction, which is a fixed amount, right, depending on your filing status, itemized deductions are comprised of different items of expenses that the law allows you to take. If the total amount of these expenses is greater than the standard deduction, then you take the itemized deduction. Not all items of expenses are deducted fully. What happened with the itemized deductions, they're reported on the Schedule A, and some of them are subject to thresholds. For example, medical expenses are subject to 7.5% of your adjusted gross income. Remember when I told you that AGI was very important because it's used to calculate some thresholds? Well, in the case of medical expenses, for example, let's say your AGI is $100,000 for the sake of the example, okay? 7.5% of that will be $7,500, meaning that your medical expenses, in order to be deductible on your Schedule A, have to be above that threshold, about that 7.5%. In the case of a person whose AGI is $100,000, it will be $7,500. So if your medical expenses are $10,000, you can only take the difference between the $10,000 and the $7,500 threshold that the law already excludes. Look at it like a deductible. Like in insurance that you have a deductible, look at it like that. When you have those thresholds based on AGI, you're allowed to take the deduction, but not fully. So don't say like, oh, I have $10,000 in medical expenses, I can take the whole $10,000. No, it does not work like that. Itemized deductions. Continue with itemized deductions. The most common expenses that qualify for itemized deductions are the following. Home mortgage interest, which is now limited to $750,000 mortgage amount. What does that mean? It means that if you bought a house and your mortgage is $1 million and you bought that house after December 22nd, 2018, and your mortgage is $1 million, you can only deduct the interest up to $750,000. That includes first home and second home. Altogether, the maximum amount is $750,000. However, if you enter into that mortgage before the legislation was passed, your grandfather, and you're able to deduct up to $1 million in mortgage interest deduction. SALT, state and local taxes, which is now limited to $10,000. This is going to hurt a lot of people in the new tax filing for 2018, because the total amount between your state taxes, property taxes, real estate taxes, and other taxes cannot be more than $10,000. Some people are losing $40,000 in deduction just on that line item. So it's going to be beautiful this tax season. Medical expenses, like I say, up to 7.5% AGI in 2018 and 10% AGI from 2019 to 2025. Charitable contributions is another item of category that is taking itemized deductions. In the new legislation, they eliminated the miscellaneous deductions. A lot of people, let's say construction workers, for the sake of the example that comes to my mind, or somebody who is in sales, but is a W-2 employee and have unreimbursed business expenses. I have examples of people that work for janitorial companies under W-2, and let's say this person is a supervisor in a janitorial company and they have to drive to several buildings to do their job, or somebody who works in sales, and anybody who used their vehicle, for example, for the performance of their job, they're not going to be able to take the unreimbursed business expenses deduction that was subject to the 2% AGI limitation in the prior legislation. Unfortunately, all these people are SOL because now they're not going to be able to take this deduction anymore. So we're getting pretty close. We know that we're not taxed on gross income, right? We all know that. We are taxed on taxable income. We know that to calculate our taxable income, we have to follow certain steps. We know we have our gross income minus the adjustments that will give me the adjusted gross income minus the standard deduction or the itemized deduction, and all of those steps that we have to take in order to know this beautiful concept called taxable income. Why do I need that? Because once I have my taxable income, I know the range of taxes, because that is the amount that I use to calculate according to that tax table, depending on my filing status. So depending on the taxable income and my filing status, I use the numeral, I multiply, and voila, I have my taxable income. So how is that calculated? So the 2017 Tax Cuts and Jobs Act also changed the way taxable income is calculated. Before the TCJA, it was calculated as follows. The AGI, which we all know AGI is gross income minus adjustments. You will subtract then either the standard deduction or the itemized deduction, and then you will subtract the exemptions. But what are exemptions? Exemptions are where, because they're no longer in the new legislation, but exemptions are an amount that the government gives you for each person you support. So if you're a single person, you only have one exemption, which is yourself. If you're a married person, you have yourself and your spouse. If you're a married person with 5 kids, you have your spouse, yourself, and 5 kids, so you will have 7 exemptions. So with the new legislation, that changed. After TCJA, personal exemptions have been eliminated, and this is going to be very painful for a lot of people, because let's pretend that this is a couple that has 5 kids or 5 dependents, plus the couple that's 7 times 4, that's $28,000 roughly, because the exemption deduction was $4,050, that people are losing with the elimination of the exemption deduction. So because the exemptions are no longer part of the equation, taxable income is calculated like this: adjusted gross income minus either the standard deduction or the itemized deduction. And voila, we have our taxable income. So the Tax Cuts and Jobs Act established the new tax rates. These tax changes are effective as of January 1, 2018. So for the filing season in 2019, these tax rates are going to be in use. And a lot of people did not adjust the withholdings, talking about exemptions deduction. A lot of people are claiming 5 exemptions in their W-4. I told people in many of the videos in YouTube to make those changes. I don't think anybody listened, but now they're gonna know when they file, because those exemptions are eliminated. However, they are giving a break for the penalties, because people didn't have time to, I guess, digest the new legislation. So they're giving people a break. If you did not adjust your withholdings correctly, they're not going to charge you for underpayment penalty of the taxes, just for this year. So the 2017 tax table, the rate started at 10%, and the highest rate was 39.6%. With the new legislation, the lowest rate is still 10%, and the highest rate, so they kept the 7 brackets, like we call it, and the highest bracket is 37%. We have the comparison for different tax tables. Single or married filing separate use the same tax table. And like I told you before, it's a number that you multiply, and there's a range. It's a little complex. It's not a straight 10% except in the lower bracket. A person that is in the lower bracket, and the lower bracket for a single person ends at 9,325. So if I make 9,325, I multiply that by, my taxable income. My taxable income is 9,325, or let's say 8,000 for the sake of the example. It's between that range, from 0 to 9,325. 8,000 follows in between that range. So I multiply that by 10%, my tax is $800. But then after that, it gets a little more complicated because you have to use a numeral plus the 15% of the amount over that number, like you see. We're not going to spend too much time on that. You have time to read it on your own and do the calculations on your own. So we have for married filing separate in 2017 versus married filing separate in 2018. What it did is, if you see in 2017 for a single or married filing separate, the second bracket, the 15% bracket, which now is 12%, started at 9,326 and ended at 37,950. For the 2018, it goes a little further up for 9,526 to up to 38,700, but it's a lower bracket because it's 12%. We have the same comparison for married filing joint in 2017 versus 2018. Same thing. So from 0 to 18,650 was 10%. Now they increase it to 1950, and then it goes on 12, 22, 24. For head of household is the 2017 category and the 2018 tax rate. So we have some observations to make about the tax rates, about the tax tables. We still have 7 brackets, right? But they have decreased overall. And these lower tax rates will expire in 2025 unless Congress vote to extend them, which could happen. The top rate is reduced from 39.6 to 37%. The bottom rate is still 10%, but now covers more income, depending on the filing status. So now that we know everything. We know adjusted gross income, we know deduction, we know standard deduction, we know itemized deduction, we know what taxable income is, we know the tax table. So how much tax do I owe? How do I calculate that? Very, very easy. So now that we know all these concepts, we know gross income, we know adjusted gross income, we know deductions, we know AGI, we know what's earned, unearned, taxable, non-taxable. Well, I just want to know how much tax do I owe. To calculate that, I need to know how much my taxable income is. To calculate how much tax you owe, which is your tax liability, you need to first calculate your taxable income using the previous formula, and then multiply for the tax rate on the tax table that is according to your filing status. I'm going to make you a really easy example. Let's pretend that I have a single taxpayer that's making a W-2 income of $21,000. So $21,000 W-2 income, that's their gross income, correct? But they don't have any adjustments, no adjustments whatsoever. So the adjusted gross income will be the same, will be the $21,000. What do I take? I take the standard deduction. What's the standard deduction? $12,000. So $21,000 minus $12,000 is $9,000. So $9,000 put me in what bracket? Puts me in the 10% bracket. So how much taxes this single person had to pay? 9,000 times 10%, 900. So that's how you do it according to your filing status. And that's it. Pretty simple, right? I hope you like it. I know you like it. And if you have any questions, do not hesitate to ask at any of the sections of the webinar. We have more webinar comments with more content. We're preparing a Business 101 taxes, Business Taxes 101. So stay tuned for more content, more webinar, more education from Global Tax and yours truly. Bye.